the sector overall is very strong, but it is the next 2 year or so period that we just need to go through. So just be aware of those realities, those factors, and make decisions in light of those.
Welcome to the Path to Wealth, the show about well-being, fulfillment, and financial freedom. I'm your host, Hannes Henschel. Good day, everyone. Welcome back to the Path to Wealth. My name is Hannes Henschel. Today we have Tariq Sattar. Tariq is a multifamily syndicator and real estate investor with over 20 years of experience. He is the co-founder and CEO of Anthem Capital. His experience working in management consulting and corporate restructuring for Deloitte and Alvarez & Marshall has enabled him to see the opportunities that others don't when it comes to large apartment complexes needing some value-add improvements. Tariq has syndicated 20 acquisitions and is personally invested in about 15,000 units, and once owned 55 single-family properties before selling all but one off to pursue multifamily investing. He is also a real estate mentor and advisor with the Brad Summer Group and has helped hundreds of people achieve financial freedom through real estate investing. He is an expert in all stages of the real estate investment's lifecycle. Whenever I meet him, he has a gentle and patient smile on his face, something that is definitely reassuring in the current market environment. It's an honor to have you on the show, Tariq. Welcome and thank you for coming to join us.
Thanks for having me, Hans. Great to be here.
Of course, I think especially in times like right now where we are riding the cycles, it's great to have somebody with as much experience as yourself that is also coach, guiding others through the cycles, and kind of making sense of what's currently going on. So what are some of the precautions or the strategies that you personally are taking when it comes to the capital that you're investing for your investors?
Right. So right now, with the current market conditions that we are in, with the interest rates and the loan sizing and the cap rate environment that we are in, we are looking at this probably for the next 18, 24 months. So really the key for me as both as a GP, as a syndicator, as well as an LP or a passive investor is to try to get to 2025, right? It is the next 18 to 24 months that are very critical. And the timing is what is really critical, really important in the real estate life cycle, from the time you acquire to the time when you're ready to sell. If you have the ability to ride through these cycles, you have more of an opportunity, you have more likelihood to come out good on the other side. But it becomes an issue if you have some event coming up in the next 18 to 24 months. And when I say some event, could be loan maturity. You have a loan that is coming up for maturity in the next 12, 18 months. What do you do with that? The valuations today are drastically different than they were 18 months ago. So refinancing, where you are able to pull the equity out or pay the previous loan off is not going to be easy, is actually unlikely, right? So, and then a lot of the deals that were done over the last 2 years or so, 2.5 years, were with floating rate debt. So the rates have been adjusting higher and higher as Federal Reserve has increased interest rates. And all of those deals required an interest rate cap to be purchased to hedge against such rises in interest rates. Now, we have two such deals in our portfolio as a GP that we have syndicated. three deals actually that are floating rate loans. And we have rate caps that we purchased for each one of those. And we, were fortunate enough that we purchased 3-year rate caps. So we have the first maturity of a rate cap coming up in our portfolio in October of 24. So we still have, this year, rest of this year, and almost all of next year before we need to purchase another rate cap. But the lender is going to ask us to start escrowing a higher amount later this year for the purchase of that replacement rate cap. And that, when some of these acquisitions were going on in the last couple of years, just because of how expensive some of these rate caps became, some of the syndicators, GPs, sponsors bought 1 or 2 year rate caps. So if you have a rate cap maturity coming up currently or in the next few months, you're already putting in a much, much higher amount as escrow on a monthly basis. I personally know of deals where the syndicators, the GPs are required to put in six figures on a monthly basis as escrow with the lender to make sure there is enough cash available to buy the replacement rate cap when it needs to be bought closer to the maturity of the current rate cap. So those are, things that you need to be aware of as you go through this cycle. Timing is the key thing. So the bottom line is you want to make sure that you are well capitalized, well positioned to be able to get to 2025, where hopefully things are different, interest rate environment is different, cap rates are somewhat more favorable, liquidity, loan sizing is somewhat more favorable, and you don't have the issues on the loan sizing and valuations that you are likely to run into currently. What I do expect to happen over the next 12 18 months, I know there are situations where the syndicators, the GPs have had to refinance just because of the financing that they currently had in place, and they have had to write a seven-figure check as additional collateral, additional liquidity that they have to bring to the table to be able to refinance to a shorter term permanent rate, fixed rate financing. So there will be more of those situations that are likely to come up. And as a result, if there is a stronger GP group and they have the ability and the liquidity to fund that gap, they will be able to do it. But you will have situations where there will be capital calls for limited partners or passive investors. I'm as you said earlier, I'm invested in quite a few deals as a passive. So I have already had two capital calls in my passive portfolio that have come through, and where I have put additional money into those deals. And that is something that as a passive investor you have to be aware of, and really understand who the syndicators, the GPs are, what their plan is with the additional liquidity that they're trying to raise, that they're trying to get by way of the capital call. And if you're comfortable with the plan, then put additional money in. But what is likely to happen in some of these situations is that the syndicators may not be able to raise the liquidity, and there may be some distressed properties that come to market, and some fire sales that are likely to happen here in the next 12 18 months. So that's a lot that I have said in a response to your very first question, but we can dig deeper into any of those areas that you may want to.
Yeah, let's unpack it a little bit. And I think the capital call you just mentioned, I think this is an interesting one. And it's something that many passive investors don't necessarily think about that when they get into an investment, that there is the potential, depending on the overall life cycle of their investment, for a call. And I think one of the questions that's interesting, how did the GPs go about it? And maybe what were their goals? What are they planning with the money?
Right. So in one of them, it is a floating rate loan, and they went in with purchase of a 2-year rate cap instead of a 3-year rate cap. And the loan documents called for the lender to have the lender has the ability to require the owner to purchase a 3rd-year rate cap if the rates increase by more than 175 basis points, which they unfortunately have. So the lender forced their hand and required them to purchase the rate cap for the 3rd year at a very steep price. This was multi-million dollars for a 1-year rate cap on top of the 2-year rate cap that they already had. So they were the plan or the need for the capital was twofold. One was to have the ability to purchase the third year of rate cap. And the second piece was some additional liquidity to continue to rehab the units, because the cost of the rehabs has increased significantly over the last couple of years
Yep.
because of inflation, because of supply chain issues, because of labor shortages, multitude of reasons, but the cost has gone up significantly. So if you had a plan going in, just picking a number that you were going to, rehab 100 units out of the 150 or 200 units that you had in the property, the higher cost of those rehabs is allowing you to rehab only half of those units. So for you to be able to implement the business plan that you went in with, you may need additional capital. So, which is what the two components of the capital call were: funds needed for the additional 1-year rate cap and funds needed to continue with the rehab of additional units to be able to achieve the higher rents, which are achievable. The business plan is proven. They have been able to do it consistently. So that is one where I was very willing to. There was a webinar. There was a lot of information that was shared from the syndicators, from the GPs about their business plan, and I was willing to put in the additional liquidity there. In the second one, it was a fixed rate loan, but there was an effort to sell the property about 9 months ago, uh, which failed because of the change in the capital markets. The loan sizing for the potential buyer changed, and he decided to pull out of the deal. There were some property management challenges, issues at the property. They went through a property management company change, and as they were going through that process, uncovered a large batch of unpaid invoices, payables that had just ballooned over the last year. There were some lower quality tenants that were brought in by the prior property management company. So once they changed the property management company, cleaned house, they wanted some additional liquidity to rehab some units and achieve higher rents, and just some additional cushion to be able to ride this period of lower occupancy. So again, there we had a lot of information available from the syndication team, and there they offered it, as an option for the existing investors to come in as debt instead of equity, where you have they were offering 10% rate for the money that you put in, and going in as debt, you are still behind the secure debt, but you are higher in the pecking order, higher than the equity in the pecking order. So you are going to get paid first because you are recognized as a loan in the capital stack, as debt in the capital stack. So that was, the second one that I personally have gone through. I expect several more of these to come through, and as I would suggest everyone else, take each one of these on its individual merit, try to understand what the plan of the syndication team is, the GP team is, of what they want to do with the additional liquidity. Why do they need it? What they want to do with it, what is their plan on the back end, what kind of valuation are they expecting, what their assumptions are for that valuation on the back end, and if they're looking to sell in 25, 26, 27 time frame, either refinance or sell, what are the assumptions, how realistic those are. So try to get your arms around understanding a lot of those things and getting comfortable with them before you decide to put additional money into that particular deal. I may not do that with every single one of the capital calls that might come through, but I will evaluate each one on its own merits.
Yeah. I've actually also been in the position for capital calls previously in also in other businesses than syndications, and sometimes it's hard to kind of understand the merits of it because it's as you said, it's based on assumptions. Like for example, the first scenario that you shared with us is largely assuming that market conditions will change favorable within that 1 year time frame that you bought for a seven-figure sum there, right?
Right. So that is right. So you're working on a set of assumptions.
Yep.
Look at the forward rate curves, which have been changing every day significantly, especially since midweek last week when Silicon Valley Bank and Signature Bank issues came out, and then today, real time, we are looking at Credit Suisse as the one that is under fire today. And this morning when I was looking at the market, the Dow futures were down 600 points, and there was a lot of downward pressure on the financial sector, banking sector, because of the concerns around Credit Suisse as the latest one that has liquidity, could have liquidity issues. So you know there is a set of assumptions on where the interest rate is going to be 6, 12, 18 months out. The reality is that historically, whenever Federal Reserve in the US has gone through these rate hike periods, it is followed by a period of no hikes and a steady state period, and then a period of bringing the rates down. So the question is, what is that time period going to be? How long?
Yeah.
When do they pause raising the rates? How long do they keep them at that high level, and then when do they start bringing them down? So you look at and rely on the forward curves, which we look at these days on an ongoing basis to see what the expectation is for the rates to be where 12, 18, 24 months out. So the expectation is that at some point next year the Federal Reserve is going to reverse course and start lowering. Whether it happens in Q1, Q2 of next year, we don't know, and how fast that comes down, we don't know either. But you got to rely on some of those assumptions to arrive at the assumptions that you utilize in your analysis, your underwriting on what the interest rate might be 2 years out, what the cap rate might be 2 years out, because those things are going to be basic factors that are going to define what kind of financing might be available when you go to market to either refinance or sell the asset 2, 3, 4 years out. And how the loan is sized is going to be a key factor in the valuation of the asset, right? So
Yeah.
it's going to be based on a set of assumptions. So you want to, as a passive investor, as an LP, you want to understand what the basis, what those assumptions are, what the basis of those assumptions is, and have an open conversation with the sponsorship team to for them to answer and address the questions, the concerns, and to share their rationale for their assumptions.
Okay. So, what are some of the best practices that you're using as a coach right now to guide newer investors through that cycle? And I mean, you've seen cycles before, and you have the access to a different set of investors that are a lot more sophisticated. And what is like best practice at the current moment?
Right. So it's not very different from what I've always said, that you when you are going into a deal as a passive investor, you are getting in, you're giving your hard earned money to someone, you're trusting someone with your hard earned money. So it's your responsibility as the passive investor to make sure you do the diligence, you feel comfortable with who you are giving the money to, what their track record is, how they are, what have they done in other situations, how long of a track record, and then you got to really understand the asset, the opportunity that you're putting money into. You got to know the market that the asset sits in. You got to understand the various assumptions. We just went through that. It's all based on the returns that are projected and marketed and promised to you are based on a set of assumptions. And
Yeah. Anything can look good on paper.
right, right. So, change a few things here and there, and it looks very good as an investment opportunity. But take all of those with a grain of salt and ask questions. What kind of stress tests have been done? The last 12-month period that we have gone through is unprecedented. That kind of a stress on any deal, there are going to be plenty that are going to break, that will not be able to withstand the pressure that is being exerted on them because the assumptions did not account for it. So there isn't enough liquidity, there isn't enough cushion. So, you got to be really digging into what those assumptions are, and really question the sponsors. And if these are sponsors that are not very available, reachable, willing, or able to give answers to your questions before they have gotten your money, think about how they will be responding or reacting when they have your money. So you gotta, the onus is on you as the protector of your hard-earned money to make sure that you do the diligence before you give your money to someone that is promising certain returns to you. If something looks too good to be true, it probably is. So if there are higher returns being promised to you, understand why that is. Higher returns usually come with a higher risk. So make sure you're comfortable with taking on higher risk if you are going after higher returns. So just do the diligence. Do the diligence, know your sponsors, know the assumptions, and then feel comfortable with the market, the sub-market, and the current environment that we are in. The
Yeah.
housing market is going to be around. It's not going anywhere. People will always need a roof over their heads. The current rise in interest rates has resulted in a cut down in construction activity, development activity, which lowers the supply that is going to come on the market in the coming years. And the increase in the interest rates has put so many people out of reach for buying a single family home. So what does that do? That increases the demand, the need to have apartments, multifamily housing. People, it just forces a lot of households to not be able to buy single family homes. So they are going to be renters for a longer period of time. So the sector overall is very strong, but it is the next 2 year or so period that we just need to go through. So just be aware of those realities, those factors, and make decisions in light of those.
Yeah. How would you compare, and maybe you've looked at this, the US housing market in terms of the strength, the yield, and the potential cash flow towards international markets? I know you like to travel a lot, and probably like myself, whenever I travel, I ask myself, and I look it from like a casual way. I look at it. I'm like, okay, how do these markets operate? And what is your view on that? How does that kind of rank in an international comparison?
Right. So, I have, as you said, I travel a lot. I've lived, in the US for a long time, but I've lived for years in Europe and in the Middle East as well. In real estate, the only market that I'm invested in is in the US. It's just the some of the you know capital stack components that you have available here in the US, especially coming through Fannie Mae, Freddie Mac, the non-recourse loans, the kind of leverage that you can get, the kind of as you get more experienced as a sponsor, as a GP, there are relationships that you're bound to develop with private equity groups, and the amount of liquidity and equity that they have at their disposal that they can give to you as part of the capital stack, as just one check. So we have done acquisitions over the last couple of years where we have private equity groups as partners, where they have put in anywhere between at least a half of the equity to up to 87% of the equity in one acquisition. So we have only one partner in that particular acquisition. Is there's no syndicated equity. There is one private equity group that wrote a check for 87% of the equity, and the GPs have the other 13%. So that those kinds of the availability of the various components of the capital stack, especially the non-recourse loans, those kinds of things that you have available here in the US, I feel are far superior than some of the other markets, and that's why I continue to focus on US as the key market that I'm invested in.
Yeah, nice. I'd agree. I'd agree. You mentioned the kind of what's going on with the banks right now, Credit Suisse, SVB. One of the questions that we kept asking ourselves in the last couple of days, looking at this, is how do we evaluate the banks we work with? And I've seen a statistic today that actually in the last almost 20 years, there have been hundreds of banks that failed in the US. Most of them are smaller. So what we're seeing right now, again, is a little bit of a larger action. And the majority of that actually happened not in the last decade, but before. Also, they don't tend to fail so much in bull markets. But how do you and how does your company kind of look at this? How do you evaluate the banking relationships and how safe they are for
Right.
the
So in,
deposits?
in in our case, we there are bigger banks that are have a lot of backing from the federal government, from the Federal Reserve, from the treasuries. We don't bank with the bigger banks. We all of our relationships, you know, are with smaller regional banks, but they are longer term relationships that have been there for a long period of time, where we know the senior management of the bank. And on Wednesday, Thursday, as SVB started to unfold, I had calls with my relationships at those banks to, and we have visibility to their exposure, their balance sheet, what kind of assets they're holding, what kind of exposure might there be, and so we have visibility to that with those banks, and they are willing to share those things with us just because of the relationship. And the length and the value of the relationship that we have with them, and we feel comfortable with that. We question
Yeah.
it, and it is something that I discuss with them every so often, quite a bit more often in the current turmoil that we're going through. As I said, I had calls with them late last week. I'm probably going to have calls with them today, tomorrow, just because of the downward pressure and the ever transitioning market that we are in currently. But it's at the end of the day, real estate in general is a relationship business. For you to get a
Yeah.
deal as a GP, for you to invest in deals as an LP, it's all about relationships. And same thing goes on the banking side. We value and trust the relationships that we have in the banking sector, but we go with trust but verify. We trust what we are told, but we want to verify it ourselves. So we look at their exposure, and what kind of holdings and investments and reserves they have, and make sure that we are comfortable with those, as we continue with the relationships with them.
Yeah. Yeah. Very nice. Well, Tariq, this has been very, very interesting. One of my favorite questions that I always tend to ask at the end: what do you consider a life well lived?
A life well lived. I'm living it. I'm loving it.
I like that.
I was in the corporate world for a number of years, walked away from it. Now, this is my 18th year, not being part of the corporate America. Have traveled the world. I worked in the restructuring world. I held a key management position in a company in 26 different countries over the years. So I've traveled. I've traveled quite a bit. Um, I enjoy what I do every single day. I love hunting. I have taken multiple trips to South Africa. Never in my wildest dreams I would have thought I'll be doing that. But I've taken trips to South Africa, to Zimbabwe, for hunting, for safari trips with my family. My kids are finishing. My daughters are, one of them has finished college, is working in DC. The other one is doing her master's, and they were just home during their spring break just last week. Our son is much younger, accompanies me, on my hunting trips with me. My wife is a physician, loves what she is doing, and she's a psychiatrist, especially focused on teen and adolescents addiction issues, and there is plenty of that going around here in the U.S. And she absolutely loves what she is doing. And we do, a lot by way of charity and helping others, helping working with organizations that help others, not just in the U.S. but globally. So, and then, I absolutely love working with other individuals that are starting out in real estate. I got my start accidentally, being pushed by my wife to buy a single rental family home as an investment. And I wish I had listened to her sooner than when I did. But thank God I did. So my real estate journey has all been because of her unwavering push for me to get started in it. So I'm enjoying every bit of it, and trying to uplift others. It's possible, it's easy, it's doable for, well, not easy, but it is doable for you to get out of the proverbial rat race, and be able to live the life on your own terms, and manage your own time. And my wife and I both are in a position where we have the ability to do that, and help others get there. So I think we are living a life that we absolutely love and enjoy, and cherish.
I like that answer. Um, Given that you coach so many people, what would you say is one of the character traits that distinguish who actually gets to the point of living life on their terms and who maybe falls back into the red race?
Two things. I think you don't want to rush into it. People starting out have this mindset, this tendency that if they don't jump on the bus right away, they're going to miss the bus. It's a bus. There's another one 10 minutes behind it. Don't
Yeah.
rush it. Take your time, what I was saying earlier, in doing your diligence with who you are going to give your money to, which markets you're going to invest in, what assets you're going to invest in. And the other is, don't give up. It's a real estate is not a short-term play. It is, it will not make you a millionaire short term, but it will make you a millionaire for sure if you stick with it. So have a longer term horizon, 3 year, 5 year investment horizon. And as some of those investments that you make initially, they start to go full cycle, you will start to realize the impact that that would have. But for that cycle to really kick in, it doesn't take a week, a month, a year. It could take decades. So it is a longer term play, but stick with it. Don't be impatient.
Yeah, I love it. And I love the empowering feeling I had too when I got the first quarterly checks and when I got the first full cycle checks. And I was like, oh my God, just once you get those, this is this aha moment where you're like, this really works.
It's real, absolutely. I had a lot of
Yeah.
skepticism going into it, but it's real, no doubt about it. And in the US, the other big thing that I did not touch on, the benefits, the tax benefits of investing in real estate, especially in multifamily real estate, are huge. My wife is a physician. I'm a full-time real estate investor. I file taxes as a real estate professional. And the tax benefits that we have are significant. We pay minimal in taxes because of the depreciation losses that we are allocated
Yeah.
by way of investments in the multifamily space. So it's the ability to grow your wealth tax deferred for a long period of time will do people do not realize the impact of that. So that is a very, very
Yeah.
big benefit here in the US.
Yeah, that's true. So it sounds like after all, we're operating and investing in one of the best markets globally seen. So
Absolutely.
yeah. Well, Tariq, thank you so much for your time and sharing all of these insight. I think it's been inspiring yourself and at the same time some real guidance. And I always love to speak to people that are seasoned like yourself. You've seen life, you've seen the world, which gives a young man like myself some guidance for the future and at the same time hope. Like, it's reassuring to hear that, this is not some quick scheme. It's just like, apply yourself over a long time horizon and be consistent and you'll eventually get there.
Yep.
So thank you very
Stick
much.
with it and good things will happen.
I love that.
All right. Thank you.
Oh, by the way, where can people connect with you? I want to make sure that
Sure.
people can connect
So,
with Anthem Capital.
Anthem Capital Partners is the name of the company that my business partner Ivan and myself started about 8 years ago, focused on multifamily syndications. AnthemCP.com is the website. You can go there. There's a book that Ivan and myself wrote based on our experiences in the real estate sector. Ivan, my business partner, by the way, is a former U.S. Air Force pilot and retired after 20 years of service. Lives here in Oklahoma as well. And we have been working together in real estate for a decade, in single family initially, and then in multifamily now. So we wrote a book. You can download a PDF of that from our website. Contact information is available on the website as well. And my personal email address, my first name, Tariq at anthemcp.com is the email address.
Awesome. And I'll also make sure to add it to the show notes.
Thank you very much.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.